Welcome friends, and welcome to the sixth and the final edition of Franstart series. This series was started for helping franchise brand owners, both which are now new to getting into franchise, and also a lot of them who are already franchising, to reinvent, think through, and build strong capabilities in their franchise program before they jump into getting into franchising. Franchising is a great scale strategy. It's a great scale strategy. It can really create a multiplier for your brand, go out and capture a large market share, also builds a huge amount of brand equity. But it is also a complex strategy. Complex strategy, why I say this, because now you're dealing with another stakeholder who also has aspirations from that same business. You also have a lesser control system. When you run your own business, you're much in control. When you are running a franchise, while you want to exercise full control, but it has to be done through your franchisee. Today's session, let's make it interactive, so you can use the Q&A box down, which is available. Can share that. I will also recommend, because a lot of times, and every who sees and comes new to this webinar, you will not benefit if you've not done the balance series, which means that the 5 series, 5 hour of content, which is already there, and all PPTs are available. And even if you want later for us to really share this presentation, we'll be happy to share with each one of them. Franchiseindia and FranCop is committed towards building the knowledge base of our industry. FranCop is the world's oldest and the most credible consulting firm in the world, started in 1976. We brought FranCop to India about 13 years back. Deepak is the CEO for that company. Franchiseindia is a 24-year-old organization which I started, and is credited to actually popularize franchising in this country. Pretty much a lot of people feel that we brought in the entire franchise concept in the market. Absolutely, from an industry viewpoint, yes, we brought the entire industry together, but franchising was being done by some of the companies before Franchiseindia was also there. A lot of retail and education companies were using franchising as a strategy. Now I see a lot of people already joined, and few are already joining. So let's begin with our presentation for today, and keep asking questions, so we don't, it's a short presentation today because I'm going to cover on different steps, while we have principally seen those models in the first presentation when we did the fundamental. Now we'll get into a deeper strategy, why we choose one over other. And that's very, very important. You know, when you are developing your franchise system or your expansion strategy, you need to really see what strategy you really want to do that. At different stages, different strategies would work for different organizations. You know, when you are a young company just getting on and you getting on your first few franchisees, there is a different strategy. When you are an international brand looking to enter a new market, there would be a different strategy. When you are somebody who wants a little bit of depth in your cluster expansion or a market share in a particular region, a different strategy. So, and we have actually worked with the various companies on different kind of strategies. So I will touch upon all those points in the presentation today, and also share some of the case studies which had worked or not worked for organizations. Can you see my presentation? It's loading.
No, sir.
Now you can see?
Yes.
Okay.
Yes, sir, we can see.
Okay, friends, so we start with our franchise expansion strategy. That's the topic for today. And just a minute, I'll just use my... Okay, this is going to be done. Your business franchise strategy, that's very important. And each business needs its unique franchise strategy. That's something which I tell every of my client and say, when you come to us, and sometimes people just follow because you have another brand in the similar category industry, and you try to follow that doesn't work. Each business would need its own franchise strategy. That's very, very important. Development of a proper strategy for any company to become successful franchise can be a complex decision. Very, very complex. And once you start working on one strategy, you cannot really change it. And because you need to really follow and do that. Say, for example, you're working on a master franchise or area franchise strategy. You certainly cannot go and change, because now you've given away the territory. You've given away the territory. If the territory is not fully developed, you will sit on the agreement to do that. So it's also very important that before you really define the strategy, you need to really define what is your horizon for next 5 to 10 years is very, very important. Franchisor has to put a very firm guidelines and say, this is what I expect from a business to do that, and that's why we choosing the strategy versus any other strategy. The challenge is knowing what is right for your company. That's very important. What stage you are in, and that stage would not mean from a business size you have, but also your organizational capabilities. What kind of capabilities you have before you even choose a strategy. You can create a franchise offering, which I particularly call the triple M theory. Triple M theory is to me very, very important. How do you make your franchise strategy measurable, marketable, and manageable? Again, I will repeat, it should be measurable, which means that everything happens in your expansion, you can measure that. It can be your customer side, how you're acquiring, what is the cost of acquisition. Everything is measured in your relationship between you and to your franchisee and franchisee to your customer. It's all measurable. Second is marketable. Opportunity should be ready for people to really invest with you. If you're not having a marketable strategy, which means that people are attracted to invest on your business model, it will not work. And this is one of the most complex areas where I and my team would work with clients very, very closely. And I would say one of the biggest credit I would like to give it to my team is that they are very, very good when it comes to creating a marketable business model. Because sometimes you have a business model which doesn't attract investors. And that's why you see one opportunity is attracting a lot of franchisees, another is not able to do that because there is a lesser marketability of the model. And you need to really see why people invest. What is their aspiration? You need to really wear a hat of an investor and say, this is how my investor would feel that this is something which is right for them to invest on, and so on and so forth. So how do you really make your franchise strategy marketable? And finally is manageable, because it's a relationship you're getting into. And sometimes the initial days of your expansion, you are enjoying it because you're selling a lot of franchise and so on and so forth, but you don't understand that this is a responsibility you've taken for next 10 years to really go out and support your franchisee and do that. And that is a never ending process. It's actually continue to have newer franchisees coming in the system, and you have to have that culture of supporting those franchisees over and over again. And especially when it comes on environments like what we have now, this COVID times, challenging times, how do you really make this whole situation more manageable in that sense? So how do you bring the triple M? That's the starting point. Before even you start writing your franchise strategy, define that what are your objective, and objective are today to me for us is triple M, which is making measurable, marketable, and manageable for you. And I think you're choosing a right strategy is very, very critical. Now let's before we get into understanding what we want to do, what strategy we want to really take in, we need to really do a deep analysis. And this is something which we start with the companies on a detailed workshop. And this workshop can be anything which is a 5 to 6 hour in a day, or we will sometimes spread it over 2 to 3 days before we even start and finalizing what is the right strategy for this particular brand to go in. And a lot of times people ask me and say, why have you given this strategy versus that? And so a lot of in-depth discussion has to be done. So first we need to really understand few things. First, overall, where are we in our operational and management capabilities? What is the franchise structure issues? Sometimes you're operationally not developed completely. You're early stage business, you're not operationally developed. You cannot transfer the systems because you yourself have not developed the systems. And sometimes you don't have complete proof of concept. A different strategy would have to be done. What is your management capabilities, especially when you're looking for a distant location franchise? Say, for example, it's good in Delhi, but if I'm having a franchise offering which is coming for Calcutta, do I have a management bandwidth to support that piece? And your strategy would completely change. Why? Because if I was looking at Calcutta and only one unit coming in, I might not do it because it will run out of my management bandwidth. But if for reasons I get an area franchise who has more value he brings in that market and works with me alongside to develop that market, maybe that's a strategy. So you really have to see what would be the right strategy when you're looking for your from your operational and management bandwidth viewpoint. Second point, similarly in this, we also understand the size of the market. This is very, very important. Last 2 months, I'm working with a Spanish company, which I'm going to launch in this Sunday. And the whole strength has been actually, work has been last 2 months is to really pick where we want to go and how big that market is. And why are we saying that market is big? So if, for example, we want to go to Greater Mumbai, is the market size about 50 units, and how these 50 units going to be span up. What are we achieving in year 1, year 2, year 3, year 4? And that's very, very important. And I see a lot of people do mistake because they don't size up the market. They don't size up market, and either they give too small regions, or sometimes they would sign initial days territory exclusivity of large territories, right? Say you are a young company, somebody comes and say, give me Jaipur, and I should be exclusive in Jaipur. And because you're getting a franchise, you think that it's selling and it is helping your business to do that. You're not in Jaipur, so it's not something which is going away from you. And you go out and sign exclusivity, and you have one unit running in Jaipur for when you start developing the business, and then it becomes very, very critical. One of the companies, we were advising and went out and signed a contract for exclusivity of NCR. Now, this is a very typical case happened, and the business was going fine. They gave somebody area rights for NCR, and later they went up and opened up something in Meerut, and the area for franchisee filed a case suit against them in a high court and said Meerut is actually part of NCR. The new definition of NCR would actually include even places like Karnal, Meerut, Muradabad as part of the NCR definition. And so it was ignorance. It was ignorance that people thought that NCR was just about the circle towns. We have the Noidas and the Gurgaons and likes of them, but he didn't understand the definition. So unless and until you clearly understand the territorial understanding of that, what does it mean? What's the size of opportunity? Why you want to give that full size of opportunity to your franchisee? Just in the rush of getting some franchise on board, never take that step of finalizing and getting franchisee. Then next we go into understanding the franchisor resources and capabilities, right? So sometimes franchises are good to know how they run their business, but they have no capability to go out and actually manage and support the franchisors, future franchisees. They don't have those capabilities, right? Because they are not developed so much in that structure. Sometimes the companies are operationally very strong, very, very strong, in-depth structure. They can take even the responsibility of operating the stores. Like one of the companies we're just advising now is called Paradise Biryani, which is a strong brand, 70, 80 years of legacy. But they don't want to give away operational capability because they feel that they're already running 45 stores. They have absolutely strong operational bandwidth. Rather, they want to keep the control with them because they feel that the quality they would be able to ensure. Now, this company, I would give this strategy because I know their legacy. I know the 45 stores operationally they're running, and they would have ability to even run that. So even the models like a FOCO, which is franchisee owned, company operated, or a couple of other models that I will discuss, might be a strategy for them. But if I would see a company which doesn't have that kind of a resources or capabilities and wants to just for the sake of expansion take a responsibility of managing the franchisee's operation, I will not advise that. I will purely say do it a franchisee owned, franchise operated, and so forth. And if your brand doesn't have awareness in that market, what kind of capabilities would be required to open up a new market before you really go out and start selling franchisees? And this is one of the problems which we've seen, that people start spreading thin. When I say spreading thin, means you're a Gujarat brand and you give away, one of the clients of our in Gujarat actually gave away franchise to franchisees in Lucknow. Now, you are a Gujarat brand, product is not understanding Lucknow, you have only 2 stores. And slowly, because there is no brand equity in that market, the franchisee would run for 6, 7 months, 8 months. And then later he said, I don't want to continue with you because you don't bring any value. And he actually changed that and became another brand. Actually, he started his own brand as a franchisee. And then they came to me and said, look, I want to really take him legal and we want to really fight this out. But to me, while you can go legal and you can really secure your rights and have some kind of a protection in your contract, that can be done. But from a strategy viewpoint, it was a wrong decision. Why you went and put the 1 store or 2 store, it's actually spreading thin. And if you did that, why you left the market open? Why did you develop the market completely? Say, for example, sometimes we have done the strategy for our clients where we have entered a new market, but then we have actually taken that market and built the cluster there. Because if you entered, say, Lucknow, and now you start multiplying Lucknow, and you have 25, 30 stores within Lucknow, Kanpur, you already build your strong brand equity in that market. So one, you be very conscious about which markets you want to enter, but once you enter, then try to build a strong cluster. Also understand where your brand sits, how trademarks are done, how registrations have happened, have you protected your IP? That all is very, very important before you even venture out. Especially Sometimes I've seen companies in the rush of going in neighboring countries like Nepal, Bangladesh. Sometimes they opened up in GCC. They don't understand any brand protection rights there. So go out and protect your brand, even if you are looking to enter the market for 6 months or 1 year, because we've seen whenever people have really start to do that, if your business model is successful and you feel that in sooner, like you're in Calcutta, and you feel that your business model is very successful, a company like Wow Momo, which is where we were advising them to go to Bangladesh. Now it's very successful. Even in Bangladesh, people know about the brand. And later you can have a issue that somebody just copies it up and try to run that same brand. And later to regain that brand becomes a very, very difficult process. So if you are immediate markets, you've not protected. India, you have only one trademark registration to do that. But if your immediate markets look like you have to do it over the next, say, 2 years or 3 years, go out and protect your brand. That's very, very important. Otherwise, somebody would just copy your brand. Next question is, what is the operating standards to be established and enforced? What kind of operating standards you really have to clearly define your business model and how it has to be established and enforced? And what are the kind of capabilities you have would also define what kind of strategy we want to really take forward on that. Like one of the companies we recently advised is a hyper exchange, which is a refurbishing business model. For them, supply chain was very critical, and supply chain was local. So we really created, they were doing only unit franchise, and every unit was struggling and say, how do I source? So I created another tier of franchise model where somebody has a more responsibility of two things. One was sourcing, and second was refurbishing factory, where you need to really refurbish. Otherwise, if you take it to a central factory, which they had in Calcutta, your supply chain times, your go-to-market capabilities, your TAT, all became very, very challenging. So we had to create this model because it needed that kind of an operational efficiency, that there has to be a tier in between coming in. What support would be needed to be provided before you even go and open up your franchisee, and what kind of local capabilities you need to have. Now, this is also would define what strategy you want to take, because even if you're committing yourself to a new franchisee, you need to really see what kind of capabilities you need from a sport required for supporting that number. Now, franchise system expansion, determining the anticipated growth projections for the class of franchisee. Different classes we will define different models of strategy, but every model would define what is the potential of that opportunity, right? And India is a very large marketplace and very diverse and complex marketplace. I always say very carefully selection of a right partner who can do justice on your market development. You know, very few companies you would find which have very uniform expansion in this country, very, very uniform. You know, you see a company like we advise, company called Natural Salons, which started from Chennai, but within South India they were successful, but anytime they came into any other market, maybe west or east or north, they were not successful. So they pretty much become a South Indian business model, right? While salon is a salon business, and only I would say Javed Habib would have been a national brand, or a Tonian guy was able to achieve, while they are not strong in West. So very few companies, I would say, have done uniform structure and expansion. And this would also mean that their understanding of those markets, what kind of model which you need to do that. Say if you feel that you don't understand, say a lot of companies don't understand, especially North companies would not understand Deep South, which means Tamil Nadu and Kerala, they would not understand. And Kerala is a very complex market, very, very complex market. You might need to have a very strong partner who can bring much deeper penetration in that market and so on. So I would not advise normally just to do one unit in those markets, because you will not be able to do the right sizing of that marketplace. It's a complex market, but a great market to really go there. You need to have much more stronger partner who understands the abilities and capabilities to be built in those markets and so on and so forth. Similarly, Northeast also looks interesting, but very complex, very spread, very fragmented in that nature. Every state has a different way of doing. Real estate has a very different play. So unless and until you have a very strong partner who can really work with you on those markets, it doesn't work. Otherwise, companies would be able to go to maybe Guwahati or a Siliguri, and that's it. They will not be able to really expand other markets because they don't have those capabilities very clearly defined and the opportunity very clearly defined. Again, you need to also further understand what is your business structure and administrative process, what kind of administrative process we need to do. Financial structure also needs to be very in-depth. We need to go in terms of initial and your continuing fee, which is ongoing royalties, model anticipated for financial performance for a franchisor in each class. So you understand, if you are just doing unit franchise, I'm just selling one unit by unit, I'm getting the entire franchise fees, I'm getting the full royalty coming to it. If I create another tier inside in between, which means that I create an area developer or a master, I say share a significant part of my fees, and I think it creates a different impact. Now, from a strategy viewpoint, this looks better strategy, because I can do a much bigger multiplier, and I will be able to share the cost, but my revenues would decrease. So now this is important for us to understand that what kind of revenue projections we need to really do, how we want to be able to do that. Now, there is a different thought process. One thought process is I go unit by unit, but entire fee comes to me. But this takes me much longer to achieve my goals, which means that if I'm doing unit by unit, I might take 10 years to reach 100 units. Versus if I go area developer route, which I've done very successfully for many companies, I can achieve this 100 maybe in 2 to 3 years, because now I have partners who are developing for me. Now, in one sense, I get more fee over 10 years if I'm doing a unit fee over that 100 units. But if I see this is faster on reaching out to 100 target. So my actually even reduced billing, if you go out and see over 10 years, would be much higher in this case. So sometimes it might look like that you're giving away something, but it is also a much faster and much more stronger capability to build that, and also able to sweat out the opportunity much faster. You're able to. So let's understand the unit expansion. This is the most popular one, and how people expand. Most of the time they're giving unit franchise. Unit franchise are divided into 4 different formats. One is franchisee owned and franchisee operated, very, very popular one. I would say 90% of our advice would always say, stay there, but you need to have an operator. Operator is very, very important. Somebody who is committed to run and operate and build last mile efficiencies in the store. If I don't see an operator, it doesn't qualify to be FOFO. Internationally, they would like to have a franchisee himself work in that business model. I am in India also insisting my companies and say, go and find somebody who doesn't mind actually participating day to day. At least take one role of the business and run directly in that business model. It's very, very important. The business owner should perform in the business. It's actually buying yourself a job. That's the kind of an opportunity FOFO is. FOFO is very strong, and only thing which is required is that 100% participation of a franchisee to participate in the business. Second business is, there is a mistake. This is again FOCO, which is franchisee owned and company operated, which means that franchisee is just investing in owning the business, but it has been operated by the company. It's just actually, if you read it, is FOCO. It's a mistake error which has happened in a typo error. So it's franchisee owned, company operated. This is typically done where companies don't feel that the management capability of a franchisee would be there, and they want to really manage that asset themselves. Very popular in hotel business. Hotels would use that because the hotel would be invested by a company. The asset remains with the company, with the franchisee, and the company would run and operate the business. That's how, say, a Taj or a Marriott or anybody would do that. There is an ownership which sits in the franchisee's books, but the company is comes and manages the business. And then there are different models on that. Are you only participating in the management, or you take a management fee? Sometimes company would take only a management fee. Sometimes they would run the complete OPEX, which means that all the operational cost and everything is on them. They manage the PL, and the franchisee gets the revenue share out of it, a fixed revenue share. In some cases, there would be other structures also. There would be fixed structure also, where companies are like in hotels. What they do is that they have different models. One is pure management fee, where the company or brand owner is actually taking a management fee. They can take a certain percentage of the books, and the rest remains in the books of the franchisee. In certain cases, they would say, we will handle the PL, all the cost and running the entire thing, but we will give you a revenue share on that. And in some cases, they would, even the premium properties are there, they would go and say, okay, we'll give you a fixed per key per month, which means that you have a 200 key hotel, I'll give you 2,000 rupees per key, and you can get a fixed return on your capital. So different models are available, but the essence is that the asset remains in the books of the franchisee, and it's depreciated in the books of the franchisee, and company is asset light and only does to managing the business. There is another model which is becoming more and more popular. This is a model where people who don't want to take a debt companies which want to grow and expand, they don't want to debt, or they don't have an equity option. They need somebody to invest in their business model, right? It's a very careful model, very, very careful model, because here the franchisee is just an investor. He's just bringing in the capital. The business is owned by the company and operated by the company, which means that asset is also remains in the books of the company itself. Company signs a direct lease. Company has a asset also in their books, and they are also operating the business. So the entire risk and operation remains with the company. The franchisee is just an investor in the business model. They just come as an invest, and against that investment, either they would take a revenue share. Revenue share would define that they would get some kind of a proceedings from the top line, whatever that top line is happening. If that is predictable, they can see that they'll be able to get some kind of a IRR return, or they would take a fixed return, which would be pegged higher than what they would get in any kind of a passive investment, which means that you put money in mutual funds or a fixed deposit or something like that, you get a higher return. Now, this is also very carefully to be really chosen and understood. It's a big responsibility for the company, because they are taking the cost of capital load on their balance sheet, because you are giving higher return than the market, and expectation would be for a investor to look at a 14, 15%, 16% kind of a return, because other assets would give them less than that, and they go out and put this money, because still risk capital. It's still a risk capital, but that is an aspiration for them to really get that kind of return. So you need to really see, is your business model good enough to give that kind of return to a franchisee, and then still you have enough margin to sustain that business model, and so forth. So out of a lot of companies want it, but we don't encourage at Franchiseindia, because we take also some responsibility that this might be create following disputes and so on and so forth. So it's very complex, but very few companies which have business models or margins which are adequately there, they are choosing this model. Then there is also a model which is a company owned and franchisee operated, which means that the company puts in the capital, but they bring in a franchisee to run and operate the model. It's becoming very popular in Europe, because capital is not the issue there. Getting somebody locked in is the issue. Talent is a big issue there. You don't get right talent to run and operate businesses. So if you are a business which needs an operator to sit all the time in the business, companies don't mind putting money, but they want an operator commitment to run and operate that business and so forth. So rather than getting a fixed salary guy, you're getting somebody who's on a variable working with you, and has also entitling. In India, I will normally not give a completely no investment model from a franchisee. I would like to see they put in commitment in that business model. So we designed a business model where there was 25 lakh rupees of investment, and the company said, look, I'll put the stock, which was 15 lakh rupees. They would give the stock to the the franchisee. All the stock comes and investment comes from the company. They also said that 10 lakh rupees of the capex which they're putting in would be reimbursed to the franchisee over next, say, 4 years. So you get 2.5 lakh rupees every single year back to you, right? So technically, all 25 lakh rupees is actually coming from the company. But the initial, when you start, the franchisee brings in 10 lakh rupees as a commitment, while he is paid back that 10 lakh rupees over 4 years. Now, what it does is you have locked in the franchisee for 4 years, because he has to take the money out. Second, he also is happy because he's getting the complete commitment. And see, a good operators, people who have not so much of money, but they're hardworking, they know this industry well. For them, this business model becomes very interesting. If in 4 years you worked hard, now you own the complete business. You own the complete business. It's all yours. And you started with a very small investment, and that also is paid back to you. Interesting business model, especially for some of the categories. Very, very interesting business model. One can do that. So whenever you're doing a unit franchise expansion strategy, always do a cluster-based approach. Don't go all over. Try to be a very strongly in the cluster. Profile your investor. This we have already covered in the previous, but I will just remind people who have not done that. We have a rule of this: strategic fit, operational fit, marketing fit, and financial fit. Profile your investor. Ideal terms of a unit franchise is going to be 5 years, and it will be renewed for another 5 years. Define very clearly renewal terms, which means that how much new investment has to be done post the renewal, which means that there are 3 components to that. One, your franchise fees, if there are a renewal fee which is available. Second, Is there any kind of renovation or reinvestment which you require in that business model? Third, is there any kind of change in the ongoing fee or a structure which you would do post 5 years? So very clearly define your renewal terms also. Sometimes I would, in the business model designing, I will waive off the renewal fee, but I will insist that the franchisee would agree to reinvest in the business, because business would need reinvestment, because business over the 5 years have depreciated. It might be new interiors or new equipment or something which needs to be done as a reinvestment. If by the time the franchisee is committed to that reinvestment, renew that. A lot of fashion brands would do that. They don't like to take another franchise fees. They anyway don't have that franchise fees, but they would insist the franchisee to redo their store identity and so on and so forth, because over 5 years the store has run down and now needs an absolute renovation to do that. And sometimes that amount is very significant for that investment. So you need to really understand. Another area which is very important, if you are especially doing the COFO, which is company owned, franchise operated, or you're doing FOCO, which is franchise owned company operated, or doing franchisee invested company operated, you need to define exit terms, because things might not go right. Say, for example, you did an investment model. People just invested and you were paying good returns over 2 years, and after 2 years, something happened. That store got a opposite place, a metro construction, and the store cannot run. Now, what do you do? From expectation of an investor, he still wants continued return, but now your business is shut. And that happened this COVID period. A lot of people were running these restaurants and bars on these kind of a model, and suddenly the business is shut. Now, investor is having expectation of return. Now, your business, which was creating yield or return for you, is not giving that return. Now, what to do is potentially a dispute, and disputes can become very, very serious in that sense. So you need to define exit terms. So if say 2 years from now, if you want to exit that relationship, what is the terms? And both parties have to agree at this stage itself. It can be either side. An investor also has a not happy with their kind of return, and he wants to exit from this relationship after 2 years. What is the kind of a time frame he needs to do that? He cannot come to the business and say, give me the money and I want to exit right away. So you need to really see and very clearly define what is your exit terms. Now let's get into a multi-unit franchising. What is a multi-unit franchising? What is the purpose? Why we use that? This is a great strategy for India. Great strategy, but a lot of people come to me and say, don't give it to anybody. I want to run this business. I want exclusivity. I want the only one who's taking your brand to that market and so on and so forth. I would say, okay, great. This is a great idea. You are taking the business to that market, but what is your plan? What is your plan? How many stores you want to open up? So good companies, big companies are always used. Dunkin' Donuts was a company which used multi-unit franchising very carefully. 7-Eleven have used that. A lot of companies have used that entire thing. In India, fashion brands and telecom brands have used multi-unit very, very successfully. Like a Xiaomi, there would be a franchisee who runs 25, 30 stores. Levi's has franchisees who run 50 stores. You will have a franchisee in Nike or Adidas or companies like that. They have multiple unit franchisee. Multi-unit means that they would run and operate all the stores themselves, not sub-franchise. So in technical sense, you are maintaining quality, but you have the same franchisee who running multiple stores. And now there is very good profiles available in the country which are strong multi-unit operators. Now, multi-unit operators are typically not the operator who would sit in the particular business, but he will bring in some kind of a strategy and business management team, a little higher level of team, experienced leadership team. Some of the companies are very large. There is a company in Delhi which runs now 200 stores for 4 or 5 brands. Say like they have taken Anita Dongre. They run about, I think, 30 stores for Anita Dongre. And similarly, within 4 or 5 stores, they would have a structure of running about 200 stores. There's a company I advise in Dubai called Apparel Group. They run about 850 stores for different brands. And large brands would be Charles and Keith and Aldo, Tommy Hilfiger. So each company, they would run like 40 stores, 50 stores. And in this case, companies would be happy to give you better offering, which means better margin, because they see you as a larger player than just a unit. They also see your commitment because you bring in brand-centric teams, strong capability teams which are there, and also be able to give you sometimes exclusivity. Say you went to a brand and say, I'll do all 20 stores in your city in Delhi, but I want exclusivity of that market. Now, these are all discussions and negotiation points which are very important. I would encourage companies which have very straight line system model, which means that you're a product company. This strategy works fantastic. Even in F&B and other service businesses, this strategy is good because you have much deeper investment from entire thing. Like a Taco Bell has given a multi-unit franchise deal for India to Burmans. Burman family is a Dabar group family, and they've taken rights for this to open up 100 Taco Bells across India. So they would continue to open up their own, but all are operated by them. So it's like a big size business, big size operations. And this is how Yum restaurants have done. They have Devyani International, which is running KFC, Pizza Hut, multi-unit kind of a franchise. But you don't have rights to sub-franchise in this business. What it helps you is economy of scale. It gives you an exclusive territory. It helps you to ability to scale your business and leveraging existing overheads. So with the same overheads, you were able to multiply that business better. Spreading the risk and reward over multiple units. So which means that you average it out. Sometimes you have not so profitable units and sometimes you have very high profitable units. So you build a portfolio and you're able to leverage your risk and reward over this entire thing. And additional margins or lesser royalties. So if a unit franchisee was given a higher royalty, in this case, it would be a lower royalty. So you have that benefit also comes in. But it should be only awarded to well-capitalized, experienced individuals and investment groups which are coming and committed to a long-term success of the business. Contract periods for multi-unit is much bigger. So they would normally have a 10-year or 15-year or 20-year contract, but very clearly with the development schedule. How many stores you will continue to put and invest on that. Defining the capabilities in advance is very, very important, and setting accountability of how many stores they need to do that piece is very important. We did this strategy long time back, I think in mid 2000, I did this for Levi's, and it was very successful because Levi's at that time just came with a very ambitious plan to do about 500 stores. One idea was go out and find 500 unit franchisees, or better would be find 5 companies who can deliver 100 stores each, right? Well, that was nobody was able to do 100, but they were able to find about 15 to 20 top partners who would be able to multiply this. Now let's go to area developer. This model I have really used in India very, very efficiently because India is a very large country and it's complex, and complexity from everything from a consumption, real estate, behavior, everything changes. And if you go and put the unit franchisees to really develop that market in a true potential is not possible. So sometimes it is getting confused. Area developer and master franchise is confused. Let me clarify these two things very clearly. First stage, area developer is somebody who has limited responsibility. Limited. It doesn't do everything. Doesn't marketing in the marketing strategy. It doesn't participate in your operations. It sometimes doesn't participate in supply chain. Very limited. Large part of an area developer responsibility is to develop the market or the cluster which you're doing that, which technically would mean recruiting of franchisees, locating the right territory, locating the right locations, ensuring the franchisees compliance with the franchisor rules and policies. This model was the first innovated by a company called Subway, because Subway thought a very large multiplier. So every market they want to really multiply. So what they do is that the strategy is very clear. They go to any market, define the market into say 15, 20, 30 clusters, and say let each cluster would have area developer. Each area developer would have a responsibility to multiply their territory. Say if I define 30 territories and each territory developer has a further rollout of 30. So I'm talking about 900 to it. Well, but now I have 30 people who are working consistently, constantly in each market and developing stores. So if each of them have a target to do at least 2, I will get 60 units every month coming in. And my focus would be parallel on all the territories on the same time, right? Otherwise, companies would do one territory at a time and second territory at a time and third. So this is a fabulous, strong strategy, very strong strategy for India, especially a lot of international companies come in. I'm working with them on creating this very strong area developer structure. Some of the things which are very important highlights in this: you have a limited responsibility as an area developer. You need to have a firm expansion targets, very, very clear. Added responsibility can be defined like supply chain and training. Sometimes you are just responsible for getting franchisees and locations for them, or running one unit yourself, which would become your training and pilot unit. But in some cases, you will have additional responsibilities like managing local supply chain and things of that nature. All the contracts would be done directly with the company, brand owner, which is the franchisor, or sometimes it is a tripart contact between three of them. Normally, it should have smaller regions, not give too much of a developer rights. It should not be given for a full country or a half a country. It should be given to tighter markets. And looking at their performance, you can scale and upgrade them, that they can go out and take bigger territories and so on. So who's the right candidate? Right candidate is somebody to me who has a capability of as a developer. He is somebody who understands scale, who's understanding. He might not be a great operator himself, but somebody who's a very good scale structure, or somebody comes with some kind of a strategic background of real estate sourcing or marketing, or getting the new franchisees on board because he has that ecosystem available very clearly. Obviously, expansion skills would be very important for me. That would be my clear qualifier. Good, aggressive person who knows how to expand a market, and somebody who also is your goodwill ambassador in that market, because he also builds the reputation for the brand in that particular market and understands development schedules, which means every area developer comes with a very stringent, aggressive development schedules, because you're taking a significant part of the franchise fees and royalty unless and until you commit to expansion. Now, the mistake a lot of people do is that sell area developer and take the responsibility of developing the market on the brand itself, which means that I just paid you and I locked the territory. Now, responsibility of expansion is with the brand owner. Then this is absolutely waste. It is a most bad decision to do, because now you are actually sharing a significant amount of fee. Maybe you've taken some upfront fee to get to the area developer, but now you just all effort you are doing, and you're sharing a significant with somebody who's a passive and not active investor. So I will not do with any area developer unless and until he or she commits on a certain amount of development schedule, and which they need to follow and really work on that. That's the essence of this business, and that's only sharing is right and doing this piece right. So now the last part is the master franchise. Master franchising is the form where the franchisor and the franchisee relationship, in which master franchise essentially becomes like a mini franchisor. It's actually becomes a mini franchise. You come in the shoes of a brand owner. You have to do almost everything which a brand owner has to do in that territory. Everything, which means everything. A good master franchisee would go and create adaptability of the business model in a local market, work on customization, understanding capability building. Everything is like you just become a brand owner for that market. You're a mini franchisor. You just duplicate whatever the franchisor has to do. You need to do on that. So it has a full responsibility basket. It needs to have a very strong long-term investment mindset to develop the market and build value. Like the greatest company which we know in India is Jubilant Foods, which has done Domino's, and they have really built a huge amount of value. But if you really look at from product creation, understanding the product, understanding of markets, how Domino works and operates in India might be different in many sense from other markets. So they have actually gone ahead and really evolved the model. But you see the mindset is they already invested for, I think, 26 years, 27 years now, and they see another 26, 27 years to go, or maybe more. So it's a 50-year horizon. It's a large business. A 50-year horizon, you build a business which would continue to give you maybe the first 5-7 years is incubating the business, and for next 5-6 years getting into a little bit of what I call growth story. Then you get into penetration story, we penetrate deeper. Then you get into saturation story, which is now Domino is that almost all markets are covered. How do you now continue to still go growth? At that time, in innovation, product innovation, new formats, a lot of this would start coming in, or finding out new delivery capabilities and so on and so forth. So they do 4 cycles, which from incubation to growth to penetration to saturation. The whole cycle structure would really work. What are the 6 essentials I would see in a master franchise? Operational capability, both the management and development. It has to have both. In area franchise, it was only development. You clearly see, I was only expecting development capabilities. I was not seeing management. But in this case, I've written management before development. Development is fine, but you need to have very strong management capability. Second, you need to have a strong financial bandwidth to really support your expansion and capability. And especially like these last 2 years, a lot of master franchise, would have to put a lot of fresh money in the system to keep the business model sustainable and so forth. Otherwise, they would be not able to sustain their network. Local market understanding, customizing of product and offering. It can be even your marketing communication, it can be product itself, it can be your service customization. All that piece is also very, very important to do that. And it will also build a lot of ground capabilities you will build, which would bring some kind of a reference point or intellectual understanding of the market, which you can then go and convince the parent and say why I need to change this in a particular market. Sometimes significant changes have been done by the masters because they would understand the local market demand and so on and so forth. So that's a very important aspect of understanding. Somebody who's also very strong in brand building, very, very strong in brand building, has a franchisee strong legal framework, runs franchisee strong legal framework, compliances and audits. That's also part of the master franchise responsibility, and training and people development is also very strong part of a master franchise. Now, master franchisees can be given for a full state or a region or a country itself. Internationally, it's the most popular way to expand businesses. Almost 95% of all global franchise brands would choose master franchise as a strategy to do that. India, I'm normally not advising people to give only one master. I'll normally tell them to break the country into 2 or 3 parts. But in some businesses, you might have to choose one single master because it has an integrated supply chain capability and so on and so forth. The relationship is 10 plus 10 years development schedule, and that's how it runs and operates. So this was today's presentation, which I wanted to share. This is the 6th part and the final part of our series. Hope I was able to give you enough information on these 6 pieces. If you have any ability or any interest to take the discussion ahead, please reach out to our teams at Francop, and Francop would be more than happy to help you in terms of your strategy formulation, your financial modeling, your operating structure, your legal, and a marketing communication.